Okay, today we're going to talk about a concept called the volatility buffer. Now, most people have some of their assets in an investment that is volatile, meaning that it's going to go up and down. We're going to dive deeper into the example of the stock market. However, this can also relate if you have a lot of your wealth invested in real estate. If that's the case, then you know that things don't always go as planned. You may have some vacancy for a few months, so we don't have that money coming in, or there could be some major repairs that need to be done. So there's two things that can happen. You may need to put money into your properties, or the money you're pulling out may be less than what's to be expected. So that volatility can hamper your cash flow. So what we're going to talk about how using a proper volatility buffer can enhance you taking out your income and cash flow from an asset that is volatile. What a great example to use on this is going to be the stock market. And if we pull up here, I pulled up a 20-year period, and actually I would say a very good 20-year period. If you look at this 20-year period, they made 12.7% a year. So let's take a look at what that means with some math here. We're going to go out 20 years, earn 12.7 every single year, and we're going to start off with a round number of $1 million. Okay, so right here, that first year, you made $127,000. Do you think that it would be safe to take out $100,000 a year? That is less than any year that you've ever earned. So let's see what that looks like. Okay. So again, you have earned every year more than what you've taken out. In fact, at the end of 20 years, you have $2.1 million in there. You've actually doubled your money while you've also taken out $2 million. Sounds pretty good, right? So let's just take note of here. Using the average rate of return, you have a positive $2.1 million. Okay. Now, if we take a closer look at the market history, is there anything that stands out to you with these rates? For me, the first year, I only earned 3%. And if I was expected to earn 12.7, I'd be a little pissed off. But then I see, okay, year 2 or 3, it's making up for it. But then year 4 and 5, we have a loss of double digits. And then it goes up. So to me, I'm seeing the volatility here in this market. One of my mentors told me that there's no such thing as straight lines in finance. So Wall Street will often share what they call the average rate of return. And I'm gonna, to me, I can give a hoot about average rate of return. I want to know about actual. How much actual money do I have in my pocket at the end of the day? So what I'm going to do is I'm going to copy the actual rates and I'm going to post them here. Okay. Now we have the actual rates here. Now, what happened to our cash? How much do we have here? In fact, we don't have anything. We're actually in the red, 1.3 million. So using the actual rate of return, you have a negative, let me repeat, negative $1.3 million. That is a swing of $3.4 million. All because of the difference in rates. The difference between that straight line and the actual line that goes up and down. This is where people get into serious trouble. When they go to retire, they're told that they're going to get these average rates of return. And you know what? In this case, you did, but we need to focus on the actual return. The problem with this situation, because of that volatility, this first year here, you took out more money than you earned. So that's why I call it a double whammy, meaning that you took out not only more, you took out more than what you earned, but that means that there's less worker bees in there to produce income. But then in the second year, when there's a good increase, you have less worker bees to kind of make up for those bad years. What if you didn't have all of your money in an asset that was volatile? What if you had a little bit in another account? We're going to call the volatility buffer. So this account needs to be liquid. It needs to be not tied to the stock market. And we need to have some guarantees because we want to make sure that that's going to be there. So what if in a year where we did not earn the $100,000, instead of taking it out of the market, we take it out of our volatility buffer? So what we're going to do here with this strategy, at the beginning of the year, we don't know how the market's going to do. But after year one, when we notice, hey, we only earned 31,000, but we took out 100. In this year here, what we're going to do, we're not going to take it out of the market. We're going to take it out of our volatility buffer. Now you see, let me just copy this down. Now what you see, instead of having negative 1.3, we have a negative 468. Better than a negative almost by $1 million. That $100,000 saved us almost $1 million, okay? But it's still negative, and that is not acceptable. So this next year here, we made 130, so we take it out of here. We made 180 here. But you look at this year, and this year, we did not make money. In fact, we even lost money. So what we do, the year after we lose money, we take it out of our volatility buffer. And then here, we lost money again. So we don't take it out of here, we take it out of our volatility buffer. Now, if you take a look here, how much money do we have in our account now? $1.2 million. So, volatility buffer. You have a positive $1.2 million. Now, if you notice here, we have a swing here between the actual and the volatility of $2.5 million. But how much money did we need to have in our volatility buffer in order to have that extra income, or that extra $2.5 million? Well, we took 3 years of income. So that means we needed to have $300,000 in our volatility buffer, and that will allow us to have our money in our account, so when it's not volatile or when it's going up, the money, our worker bees are still going to be there, and we're going to earn that income. Hopefully this was helpful. I know it was a lot of math, but the point is, when we have an account, whether it's a rental property or the market or a business, somewhere where that income stream is not consistent or guaranteed, it's important to have some money in a volatility buffer to kind of help you during the times when it is volatile. Hope that was helpful, and go have a fantastic day.